back to the Compass. My name is Derek Macpherson. I'm Executive Chairman of Olive Resource Capital. And with me, as always, is Sam Pelaez, President, CEO, and CIO of Olive. As we were sitting down reflecting and thinking about what to speak about this week, we're kind of grasping at straws a little bit. And part of that kind of came from the point that we kind of reached a quiet point in the market. If you look around and you look at what companies are doing and what's going on, sort of the markets generally seem to have absorbed the tariff news, which I think is positive. So markets have stabilized on that, and everyone seems to be waiting for kind of what's going to happen next and where the next shoe drop is.
It was a whirlwind first 90 days of the Trump administration. The past 10 days seems like nothing's happened, and it's naturally been reflected in the market. We were talking earlier today, and you said it very well. Like, the market is just sitting still, waiting for direction, and it made me realize that that the market has become sort of addicted to trading on headlines, and who am I to criticize it? But doesn't sound like the right mindset for investment. But yet here we are. We wake up every day with a portfolio that we manage, and we have to make decisions.
Well, and I think that's a little bit, we tend not to trade on the headlines unless it's something that's significant. We try and look medium term for how our investment decisions go, right? And what we're putting money into, medium to long term even. But not needless to say, the headlines affect our day-to-day mood because it affects the value of the portfolio. But I think, besides these quieter moments being an opportunity to reflect, especially on all the volatility that has happened, and think about what's going forward, the way we kind of have to think about this period, right? We're in actually Q1 reporting right now, right? Both for resource companies and for generalist companies. I think that this is going to be a bit of a catalyst, could be a bit of a catalyst for the gold space. And I guess it's for two reasons, right? I think first is that you've got in the more general equity space, Walmart is going to report, and they are going to talk about the impact of tariffs on their business, right? Alcoa reported. I didn't actually see it, but they're going to talk about the impact of tariffs on aluminum. You're going to have. So we're going to get a lot of on the generalist side, we're going to get a lot of this tariff news, right? And which is volatility in earnings outlooks, potentially, what things that investors don't like. On the flip side, you have gold companies. And so, if you look at, Agnico Eagle just reported. So, we've said it here before, Agnico Eagle is probably the best run gold company out there. They reported very good numbers as they usually do, and very consistent with their outlook. At an average price of $2,900 gold in Q1, they were generating $6.7 million in free cash flow a day. It's a pretty impressive number, but that's at $2,900 gold. We're at 34. If you all else being equal, they're generating north of 10. So I guess, Sam, from your experience, a little more of a generalist background, what is, if you're sitting there, if you're in New York and you run a hedge fund or a long-only mutual fund that kind of has a similar outlook to us, medium to long term, you're not trading headlines, what's your approach? Or how do they approach it? I guess this is what we're interested in.
Yeah, so the two dominant drivers for generalist investment are what we call stock price momentum. So whatever's performing well gets chased until it stops working. So for large cap gold equities, that's definitely a check. I think we pulled up the numbers this morning. On the S&P 500, the best performing stock so far is Palantir, which is up 49%. Agnico Eagle is up 50-something percent. It's obviously not part of the S&P 500, but just to put it in context, if it were, it'd be the best performing year to date. Newmont, by the way, which is a S&P 500 member, is number 3. Up something like 45%. A lot of investors start looking there, generalist investors. What's working? Let me be part of what's working. Second, and perhaps more important when looking at the fundamentals, the things that investors, large cap investors, like the most is revenue growth and the growth of net income or free cash flow. That's the definition of a successful company in the broadest sense. A company that can attain more customers, or in this case, sell more at a higher price, and obviously that can translate that into money at the bottom line, earnings. I was shocked to pull up the numbers this morning and realize that Agnico Q1 to Q1 last year, revenue growth is 36%. That is fabulous. That puts it in up there with the fastest growing companies in the world. It's beyond, the most successful tech companies at the peak were growing 20% a year. So just to put it in context, it's quite exceptional. And naturally, that's not exclusive to Agnico. We just like to highlight this company because big scale and also flawless operation over the last, let's say, 10 years. They had some issues 15 years ago, but very well-run company. But in that same view, we have other companies that will start to attract generalist interest. Our favorite that we mentioned before is Anglo Ashanti. If you said Agnico is making $7 million or made $7 million in free cash flow in Q1, Anglo, give or take, is doing about 50% to 70% of that, depending on which metric, which it's quite exceptional as well, especially when you factor in that, in our view, they have probably the best growth asset in the gold space that's currently available or in the process of development.
Yeah, I think that's an interesting, though. Like, if you look at take a step back and look at that context, right? Like, there's been a lot of people bemoaning share price performance for gold equities because they haven't performed as well as the gold price. Well, that's shifted to large caps. It has for a while. Then we're starting to see that trickle down. But I think the big thing is what you see in the cycle, and maybe it's a little bit slower this time than it is in previous cycles, but it's the cycle's the same usually. Is what happens is the generalists come in and start buying the large caps, and there's been a delay there because up until very recently, and even Newmont hadn't reported a good quarter in 2024. They didn't. Barrick has been struggling and has a lot of negative political headlines. They said the official they're changing the name this morning. So they're not a gold company anymore. Good timing. And so, those are the two biggest companies in the space. And if you're a generalist and you're like, oh, I need gold exposure. If you're a generalist sitting in New York and you're like, I need gold exposure, you got to go buy it. You're like, okay, I better go buy Newmont, right? Because it's in the S&P 500. It's in your index that you're going to be measured against. Us in the industry complain about the large cap peers, but I think the fact that Newmont finally has sort of gotten its house in order and had a good quarter, I think or a better quarter, I think that is a positive for the space and helps attract capital. And inevitably what happens is that as money flows from generalists, like, the gold market is still relatively small. Despite Agnico being up 50%, the performance we've seen this year, it's still relatively small. And so when capital flows to it, there isn't a lot of space. And so you get outsized move to the large caps. And then what happens is the resource funds who see their weighting of large caps go up, and now that all of a sudden they can manage their liquidity, they can actually go down cap, right? And then that's where you start to see. And I think what we're going to see is large caps, small cap. What you see is mid caps, kind of producers, and then you see developers, and then you see explorcos. We're still, it's interesting. You're still seeing performance in explorcos, just not as very select, right? It's trickling down slowly, if that makes sense. And it always does. You don't get to the ninth inning till the ninth inning, right? Where it's, you have a geophysical gold anomaly and you can raise $20 million on that. Like, we're not there yet. A geophysical anomaly that's close to a gold cap. So I think that's I think we're seeing it play out. But I think it's playing out slower.
I agree. And a lot of people ask me, and for you, I'm pretty sure it's the same, is where do you think we are in this gold market? The answer is, the generalist investor is not there yet. So whatever that means in terms of innings or percentages or whatever measure you like to use for timeline. But one thing that we've seen, particularly since 2020 and the end of the pandemic, is how the momentum is taken to extremes, especially on the upside. It happened with all the work from home related stocks in 21. Happened with the broader market as well. Then after that, it happened with coal companies. If you look at the large coal companies, they had some exceptional performance in 2022 and 2023 even. Even some of the oil and gas names performed exceptionally well in 22 or 23, far beyond what I expected. So in this case, I think we're staring at, you know, the hockey stick moment potentially where things have moved up. You know, in the case of Agnico, AngloGold, and some of the better names, they have moved up quite a bit, but nowhere near what I would call like a blow off top or an excess. We're faced right now with, you know, like what looks like a reasonable and expected consolidation in the gold price. But, you know, the fundamentals are there for the generalist investors to come in. I haven't fact checked this, but Agnico could be at its cheapest valuation in terms of a multiple that has been in a long time, because if they're making $7 million a day in free cash flow relative to their 60 billion enterprise value, then they're trading at what, 2.5? Sorry, I'm getting the math wrong, but they're probably trading at some of the, something like 10 times free cash flow or 15 times free cash flow, which is potentially one of the most attractive entry points from a valuation perspective that you've seen in years, potentially ever. I don't know. Worthwhile doing the math here.
Yeah, but I think that's where you get, and that's what's going to attract generalist investors, because they're not there yet. They're going to look at it. They don't have a position, right? They're not already invested. So they look at that, they look at those numbers and go, oh, that's a pretty attractive free cash flow multiple. It's growing because the gold price is going up, and this company executes on a year-over-year basis. So we can put money there. Can't be said for all gold companies. I think that's what, whereas if you're us and you're looking at it and you're looking at gold sort of consolidating on the short-term basis, yeah, we were a little more aggressive adding the gold at the beginning of April, some of our more liquid names, but right now we're kind of sitting on our hands a bit, right? Because we think that there might be because of the consolidation, there might be a more attractive entry point to add. But you never know, right? We're also positioned, so it's different. We have a different hurdle to take that leap. So I think that's
what. Yeah. No, when I look at charts and I start doing my esoteric thinking, maybe there's another 20% here on Agnico, easily attainable. For a new generalist investor, that's a lot of money. For us, where we see other opportunities to make 100% returns, that you start seeing that maybe not everybody's buying at this price, right? And like you said, maybe we start seeing some of the rolling down cap, as you like to say, into opportunities that provide higher alpha, albeit higher risk, but that's the space we are active in. And, there's a natural transition, like I said, from maybe the value guys who were there 3 years ago and bought Agnico at $40 or $50 US and now are sitting on it at 120 US, to transition out as the generalists come in and pick up for that extra 20% that you may see this year. I don't know. But it's different investment models, right? And there's room for all of them.
But I think that transition that we're talking about, right, that we're kind of talking about, that's going to benefit more of our portfolio and probably more of people who are listening to this portfolios, because generally you own, we own large caps, but we also own mid caps, and we own developers, and we own explorers across the spectrum. And I think what you're going to get, I think what we're going to see, right, and we've seen it a little bit, is that, like I said, if you're a resource fund and you've got to maintain a certain liquidity requirements, but all of a sudden you're up, on your Agnico position or on your Anglo position, which is up a similar amount, you're up 50% a month. I think that you're going to it's easy for you to take profits and go, okay, where can I make good returns? And that small amount of resource capital all of a sudden grows a little bit. We have a little more money in the space, and it moves down cap. And I think that's the process that we're going to need to see, right? It is going to be May in 3 days. So, maybe it's a quieter summer. Maybe this as this tariff thing plays out, maybe the debt ceiling comes into play and creates a problem, and creates that next liquidity call and push towards gold. We don't know, frankly, and I wish we did. It'd be a lot easier to do this if we knew exactly what was going to happen. But I think the I guess the thought process is that the key for us is that it's coming, right? Like all the signs are there. It's going to be volatility in between, especially with what's going on in the U.S. But that volatility, creates attractive entry points.
What you said reminds me of, there's a podcaster. He says, if I knew everything, I wouldn't be here talking to you. If I knew the answers to all the questions on where gold's going, I'd be sitting in my computer trading futures and getting obscenely rich. I wouldn't have time to record this podcast. And, obviously take everything we're saying with, due measure. This is our opinion. We're often wrong as well. That's part of the exercise. But I guess thinking, going back to that point from the very beginning of the episode, where we're saying that, we try not to trade specifically on the headlines. In particular, I prefer to read the monthly journals rather than the daily news, because if you're going to write a paper for a monthly or an article, you have to be certain that it can survive the printing period and the editorial period until it gets published. Whereas day-to-day news, headlines, they only need to survive the next half an hour. So there's not a lot of care into what's put into them. And with that in mind, and we talked about this maybe 3 weeks ago, how we're positioned and how we're sort of attacking this market. We have been investing into fewer and fewer companies. We have been consolidating our portfolio into the names that we have the greatest conviction in. And that's partly a response to the volatility, because obviously, if everything goes wrong, you'd rather be married with the stocks that you have the greatest conviction in. But also, if we're right, we think those are the opportunities that stand to generate the most alpha and outperform the market. But in terms of, and perhaps what the audience is more interested in, is sector allocation. We have about just over 50% of our assets in gold and PGMs. We have 2 smaller silver holdings. But generally, we think, obviously, gold has been the place to be. We're not specifically a gold investment product. So we have a decent amount of exposure. We would have liked to have more, but if you know our portfolio, we have some privates that obviously take away some of our ability to deploy further. But we continue to believe that gold is a place to be for Q2. I don't see any reason to change the allocation. We may face consolidation here in the gold price. The US dollar is significantly, maybe massively oversold. So, a dead cat bounce on the US dollar could be in the cards, and that would affect, gold by anything, $100, $200, $300. But it doesn't really materially affect the trajectory that we are on. The US Congress is going to have to sit down in the next 60 days to discuss the 2025 budget, which they don't have. They, halfway through the year, they don't have a 2025 budget. And that also includes the raising of the debt ceiling. That's going to be incredibly volatile, I'm sure, in terms of headlines. The Congress is obviously not, even though it's controlled by the Republicans, it's not 100% aligned with Trump at this time. So anything can happen in that period. And for us, with that view of the next 60 days, we continue to believe that even with the risk of a US dollar just dead cat bounce rebound, we continue to think that gold is the place to hide.
Yeah, I think that's well put. And frankly, if there is that, I think for us, the way we're looking at it, for our portfolio, like I said, we already have pretty good gold exposure, as Sam outlined. We're looking at consolidations and pullbacks in the space, and our favorite names as opportunities to add if they appear. And so I think that's an important the important takeaway for those of us that are already long the space, I guess, for lack of a better description.
And I think beyond that, well, we have some, PGM exposure. That's, call it, longer dated, but it's a market that we fundamentally see as, imbalanced in favor of the new projects. And I asked this to a lot of people. When was the last time you got a call from a broker or from anybody to pitch you a PGM project or a PGM company? That's typically a good indication that the market is oversold, and it will, in a situation to offer you good value opportunities. So we've identified a few of these, and we have invested in them. And that goes back to the not necessarily investing on headlines. There hasn't been a single positive headline for PGMs in I don't know how long, but they will come. It's a fundamentally imbalanced market controlled by South Africa and Russia, none of which can provide enough supply to the market as it stands. So that's another area where we have exposure. We have last year we reduced our oil and gas exposure significantly. And we're favoring gas over oil. If you think about just general market dynamics, when crude prices drop, activity diminishes, and natural declines of oil production take place, which means that there's less natural gas that comes as a byproduct, especially in the US. So that tends to be favorable for gas prices globally. And beyond that, I don't know, Derek. We have very specific copper exposure because we have a long-term view on that one as well.
Yeah, but I think those are all, and we have stuff on the we've dipped our toe in the water on some of the lithium producers. We've done we're kind of small, but I think the focus for us is I think if you look at it, we own gold and we've increased our exposure because we think that there's still a lot of money being made there. But I think that when we look at the rest of the portfolio, one of the big things is that, when we talk about some of these names, we talk about some of these commodities like copper or PGMs, we own names that you aren't going to get in once the market turns, right? They're generally a little bit less liquid names. When the PGM market turns, and we saw it turn in, I think 2016, 2017, 2018, where palladium exploded. Probably going to get that again. It's a real possibility. And because of how tight those markets are, when that happens, doesn't matter what you own. If you're not there already, it's gone. But that creates attractive entry points, right? We can, buy these really world-class assets, tier one, what we view as tier one assets, right? At a discounted price. We're not chasing. We're not have to buy, when you're chasing the market, you have to buy lower quality, right? Because those good ones go first. So that's kind of how we position it. But I think that's for future. I actually, perhaps in a future episode, we should really talk about PGMs, what we think of the market, where the supply demand dynamics are. Sam and I both spent a lot of time looking at it, so it's not something I think we can talk intelligently on. So perhaps a future episode, we can talk about where we think we are in the PGM market, what we think it means. It's one where geopolitical matters, but I think there's attractive entry points because we're at an attractive entry point because when it goes, it goes. Did we pick the bottom right on? Who knows? But are we up on all our PGM positions right now? Yes. So maybe we did. But I doubt we did. But that being said, we're able to slowly add to those unfavored positions. So I guess with that preview on PGMs, in Q2 we're long gold, and we're going to stay that way.